Welcome to the Accumulating Wealth Podcast. I'm Hunter Satterfield, a CPA, wealth advisor, and partner at CWA, where we help business owners navigate the financial decisions they face every day. Today, with Judson out of the office, I'm joined by a guest for a wide-ranging conversation on what's happening right now. A little scatter shooting, some fun in the economy, in the markets, and then just broadly the headlines that we've seen over the past few weeks that are shaping decisions for business owners and families. We might even do some March Madness picks. So if you're trying to make sense of the noise and focus on what actually matters, you are in the right place. Let's go. All right, folks. Longtime guest, not a first-time guest anyway, Scott Clynch. The great Scott Clynch with me, as always. You might remember him from famous July 4th episodes of eating spam and things like that, right, Scott?
Hot dog and spam fame. Hello, everybody.
That's right. Yeah, Judson is out of the office for the next few weeks, so Scott's going to join me. We'll have a good time.
Yeah.
You do have a radio voice afterwards, after all. But you were probably listening to this after the first round of games, but Scott and I were like, we need to have a little bit of fun. Without Judson here, we've got to choose our March Madness team. So we're going to go with our final four teams. And I am not going to pick Texas, even though we won the play-in last night. If you don't pick Tech, you're fired from this.
I was about to say, look, selflessly, I have to pick Tech as one of my teams in here. We did lose our best player, JT Toppin, tore his ACL.
Excuses.
I honestly think we were going to win the whole thing with JT Toppin. We're dangerous now. We're like a wounded lion. You just don't want to mess with us. I am going to pick Texas Tech as one of my final four.
Okay.
I feel like based on history, you have to pick at least two of the number one seeds because they're going to make it. So I'm going to go Arizona. I got to support the Big 12. So Arizona and Tech. Wait a minute. Is that even possible? Yes, it is possible.
Oh, yeah, that is possible.
Arizona, Tech, Duke, and I'm going to go with a random pick here. And
Idaho.
go with Houston.
Oh, okay.
It's not that random.
You should have gone Idaho. Whatever.
Vandals.
Okay. Those are good. I am not selecting Tech, but I'm also not selecting my team. I'm going to select my son. I'm gonna select the Arkansas Razorbacks to come out of that. What division are they in? They're in the the West. Arkansas, and then I'm gonna go with let me say Michigan. I'm going to say Houston and the Duke Blue Devils. Final answer.
I do think it's tough. Tech is in the Michigan bracket, and honestly, if I had to put money on it, I would say Michigan's going to come out of that bracket and not Texas Tech, but I'm not going to do that to my Red Raiders. So,
well, in all likelihood, thankfully, most of our team should be still alive by the time this airs. Hopefully, that's the way it works.
I hope so.
All right.
Get embarrassed in the first round.
That's right. Okay, folks, lots of stuff today. We're actually going to start with some breaking news. You know us and inflation. We love talking about inflation. So inflation did drop this morning, and I don't think, Scott, that we're going to have any rate cuts anytime soon, despite what Trump is pushing for. So PPI, which is the Producer Price Index, PPI inflation rises to 3.4. Expectations were 2.9. So there was a beat there to the high side. Core PPI 3.9, expectations were 3.7. Bottom line is that we are at highest inflation since February 23, and this doesn't actually include the stuff due to the Iran war, which would obviously make things even worse just because of energy prices and things like that. So, look, what we do with this is I don't think we're seeing rate cuts. We may see them later this year. There's obviously a new Fed chair coming in as well, but I think that at the end of the day, we're probably not seeing rate cuts anytime soon.
Yeah. Y'all have talked about this on the podcast before with all the geopolitical issues that are going on, and the market really has not been affected like we might think it would with all that going on. So I think if we look at the last 5 years, we see that the market has ultimately mostly been driven off of rates. So I don't know what that means for the market this year. It's not a major miss, but you would think that all the things going on around the world right now would have a bigger impact. My guess is this is going to have a bigger impact than everything else that's going on.
What's really fascinating, I think, is obviously, the market's not responding that negatively today to it yet, which seems to indicate that it kind of expected higher inflation. I think where we could see things go very negative is if we do actually see rate increases, which are now odds are actually pointing could happen this year. So I don't know, folks. We'll see. We said we weren't going to talk about interest rates all year, so we're going to move on from that topic. Let's throw that in the garbage can right now.
Done. Interest rates.
So instead, we're going to talk about something we've never talked about, Scott, AI. Dun, dun, dun. All right. No, this is actually kind of a cool topic, folks. And by the way, we are going to talk about April 15th reminders, so stay tuned for that. the brand new Robinhood credit card, if you haven't heard of that one, some S&P stuff as well. But this topic that we wanted to start with was just some interesting stats that have come out related to what AI is doing on new business formation. So I know you're like, wait, what does that even mean? So there was a great stat that came out just a few days ago that basically looked at weekly business formation over the past 20 years. And of course, during COVID, it spiked dramatically, right? Because everybody's sitting at home saying, how can I work from home for the rest of my life and never return to the office? So it spiked, but then it started to go back down post-COVID, and we're actually seeing it rise now. The number really since the latter part of 24 is accelerating higher, which, it is definitely sort of a macroeconomic issue, for sure. That being said, I think a lot of it is if you just sort of listen to the headlines, look at the headlines. I've talked to several clients. People are starting to use AI to build businesses, right? I mean, they really are. They're sitting there saying, man, I could build an app now and I don't even know how to code, right? By just talking to it. I'm seeing that with my clients. I've had several employees that are like, yeah, I'm doing this fun side project on the side as well. So you then went and pulled some interesting stats from the SBA. So you want to riff on those real quick?
Yeah. I mean, I think that the AI has removed a huge barrier of entry for, I think that's what the chart tells us, right? That it's removed a huge barrier of entry. Maybe it's on the legal side, just getting set up. That's something AI can very easily come in and do. Set up an LLC, tell you how to do it, tell you what forms to file, right? That simplifies that process. Building a business model is something you can use AI for. So I think that it increases confidence in folks that want to start the business. That's obvious. Something that AI cannot ever replace, though, is lending. So as soon as I saw the stat on starting up a new business, my next question was, what does the SBA look like over the last few years? Does it back this data up? Are people going and getting more loans from the SBA or banks in general? So I went to the SBA website and I pulled up their 7A program. If you're unfamiliar with the 7A program, the SBA does basically two types of loans. They do a 7A and they do a 504. The 504 is kind of mixed between government risk and bank risk. So it's almost partnering with a bank to get the loan out. So both share the load, the government and the bank. The 7A program is mostly shouldered by the government. So the 7A program you can look up every bank that has issued out those loans, the year, how much it's been issued out. I just looked at the actual approval count. So we're only in March. 2026 can be thrown out, right? It's not going to be a full year of data. So I started with 2025, and in 25, there were 78,000 loans issued under the 7A program.
For the whole year?
For the whole year. In 2024, that number drops to 70,000. In 2023, it drops all the way to 57,000.
So that's crazy. 57,000 in 23, 78,000 in 25, which
Correct.
is basically damn near 40% growth in approved loans during a time where interest rates are skyrocketing.
Correct.
Which is wild. What was the number? 22 was like half.
2022 is 48,000.
So damn near half what was approved last year. And the numbers in 26 are skyrocketing higher as well.
Right. So interest rates went up how much in 2022?
Yeah. I mean, they were up 300, 400, 500 basis points at a minimum. And these SBA loans oftentimes are at higher rates than a conventional. I mean, doesn't that tell us that people just aren't scared?
Yeah.
They're going to just start a business.
Yeah. I mean, I think it's the trust in technology might be a little too high. That's a little bit scary in my opinion. I've even had some of my own clients say, hey, I went into Grok or ChatGPT and built out a plan for opening a second, third, or fourth location. And I'm like, that's great, but let's, slow down just a bit. So I think confidence is at a high because the ability to understand what is needed to start a business. And that has really trumped the fear of rates being any higher.
Yeah, and there's obviously there could be some pain on the other side. Even though these are government backed, there's a lot of businesses that are being started up. Like I said, 45% growth in the last 3 years. So there are some things that could, look bad in that. But I think that supports a lot of what we're seeing, which is GDP growth has been good. Obviously, inflation, as we've already talked about, continues to go higher because people are starting businesses. They're developing their own business models, et cetera, et cetera. And I mean, I think that this is like broadly bullish. One of the things we always get questions on, which I talked about in Nashville, is AI going to take my job? And I think the reality is that the new businesses being formed with this technology is actually supportive of more job growth.
Yes.
Which is something that we have talked about at length.
Yep. Again, I think we talked earlier about the geopolitical issues and how the market hasn't reacted wildly to that. Maybe this is just backing it even more so than what kind of negative pull that would all have on it.
Yeah. So lots of interesting things sort of coming together there, folks, which we'll maybe talk a little bit about the implications for the stock market here toward the end of our episode. That being said, Scott, we are only 3 weeks from the wonderful filing deadline of April 15th.
Bum, 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 bum.
My favorite day of the year. Not really.
No.
That being said, again, let's do some April 15th reminders. But before we do that, I found an interesting link to the IRS website. This is interesting to maybe me and Scott only. Total returns filed in 2025, 165 million returns. That's crazy.
Yeah.
I mean, especially when you consider there's 350 million people in the United States. A lot of people are filing married, filing jointly, but there's business returns in there, partnerships, 165 million, which is about a 1.5% increase from the prior year. Of that, almost exclusively 155 million of those were e-filed. That means there's still 10 million of you out there, 10 million returns of you out there that are sending it paper.
Well, I think that could play into the other,
Could be some of the fraud.
the fraud stuff,
Yeah.
right?
Yeah, it could be that too, which is interesting. Total amounts refunded with direct deposit. You see that number? The second one from the bottom?
Yeah.
$305 billion refunded. Come on, people. We got to get our
money.
Wasted money. IRS ain't paying you interest on that, folks. And then almost a billion, excuse me. There's one less comma. A billion people that went to irs.gov last year, which is bananas.
Yeah.
All right. Maybe that's why they
the
can't get anything
thing cracks me up. I'm sure all of us in this room, or me and you at least, Hunter, I know I have family members that I fight this battle with every year. They get so excited for the refund, and I'm like, no, my CPA brain tells you don't get excited about the refund.
That's right.
You should owe the IRS a small amount of money.
$1,
Yeah.
Bob.
That's right.
All right. Okay. April 15th reminder. So first off is our annual reminder. Everybody listen right now, wherever you are, on the Peloton, in your car, I don't care, walking, listen right now. Stop and listen. The IRS is never going to call you, ever. They're not going to call you, ever. The only communication you are going to receive from the IRS is via the good old U.S. mail service. And this is particularly important because now in this age, so actually, crazy story, my middle son, who's a junior, was taking the SAT this weekend at his local high school. Somebody called it a bomb threat. They cleared the room. They have to now take the SAT next week instead. And it was an AI SWAT call. And now with like the technology that's coming out with AI swatting, like there are more and more calls that are going out saying, hey, this is the IRS. That is not going to happen. Right, Scott?
Correct. Your local senator might call you when an election year comes up.
That's right.
At least their computer, but they are not going to call you.
No texts, no calls, nothing.
On that same note, because they use the mail service, something to keep in mind, if you are communicating with the IRS about a notice or something that you've received in the mail and your CPA has responded to that, don't be surprised if in the meantime you get another notice, because things take time to travel through the mail. Sometimes your CPA might have already responded to something. Maybe it's all taken care of. 2 days later, you might get something in the mail because they sent it 4 days ago before your CPA dealt with it. So on the there's the trust side, but then there's also you got to be patient with them because they do things at a snail's pace.
Indeed. Okay, Scott, if I was trying to file a simple tax return for my kid, are there options out there other than my CPA that I have to use? How would I do that if I wanted to do that before April 15th?
I am so glad you asked that, Hunter. There is actually an IRS free file website that you can go to. They contract with various different tax preparation software programs, and it's all free. It's based on number of dependents. It's based on income levels. There's a lot of things in there, but specifically, if you've paid your kids, if your kids are working and they're in college, they're in high school, they're making less than, let's call it $15,000 a year. They get a W-2. It's simple stuff. You do not need to pay to have that tax return prepared, and it also will take about 10 minutes to prepare, even if you have no idea what you're doing in terms of tax return.
That's right. You can do it during halftime of the Texas Tech game.
Yeah.
That's right. Yeah, super simple. That's how my boys and I have done it. It's really good. Sit your kiddo down next to you, get their forms out, walk through the process. You can also do state returns as well there. So go to irs.gov, go to file my taxes, and there are some links on there. Moving right along, Scott, should people fund their IRAs and HSAs before the deadline?
Yes, you should.
Oh, but what is that deadline?
The deadline is not December 31st like you might think it is. You actually have until April 15th the next year. So it's, as of today, recording day, it's March 18th. You still have almost a month to fund your Roth IRA, HSA for 2025. You technically could even fund 2026.
I think it's a great idea. I think it's a great idea. If you have the money, go for it.
So if you've been behind, knock it all out at once. I know for me, I for my clients, I do this on their console date. Keep it simple. Don't overcomplicate it. Just try to knock it out during that date.
That's right. All right. Other things that happen on April 15th is, of course, your estimate and extension payments are due. So reminder that your extension for last year, your extension payment, and your estimate for this year, your first quarter estimate, are often paid at the exact same time with your extension. So that is due on April 15th, both to wrap up last year and not pay penalties, and to stop, or at least start this year and not accrue penalties as well. Now, Scott, most of those are done now electronically, correct, at the federal side?
That's correct. No more vouchers, no more cutting them off at the bottom, going and digging through your junk drawer to find a check. Who has a check anymore? Don't have to do that. It's, in fact, not that you don't have to. You actually have to pay them electronically starting now.
Yeah, and producer Erin just raised her hand. She still has checks. So if you're looking for a check, I'm sure you could Venmo her money, and then she could write the check for you. Other things, PTE, for if you live in a state that has PTE, you might have an election 315, 415. So get with your CPA on that. And then probably the last one that I was thinking about, Scott, was folks that maybe put a building into service last year, whether you bought it, whether you constructed it, you still have time to do a cost segregation study to accelerate their depreciation on that. And you can do that all the way up until you file the taxes, right? Because your CPA just needs to know what depreciation to throw on the tax return.
Right, but it could impact your extension payment. And just a reminder there, I think most people know this, but just in case you don't, the extension deadline really only allows you time to extend the filing of the return. It does not allow an extension of paying the taxes.
Not with that attitude, man.
So that's why you need an advisor. You need a CPA like us, because we go and calculate what we think you're going to owe, have you pay that at extension time, and then it buys us several months to just get the paper filed.
That's right. And hopefully we owe $1 when you actually go to file it.
Correct.
So tax time, as always, fun. We'll continue to come with information that's dropping. In fact, some states, interestingly enough, there's one state that is probably pulling PTE. So that's interesting. Once that's final, we'll probably announce it on here. But all kinds of changes, as always, to that system. So, okay, moving right along. I thought this one was hilarious, Scott, and I thought we'd spend just a second on it. Robinhood came out with a new credit card for those that are not clued into social media like we are as finfluencers. You might not have seen this, but they came out with a new platinum card, and the advertisements, Scott, say $3,000 in benefits. And it's kind of hilarious because they're really crappy benefits, but they say that, right? So first off, our thoughts on credit cards, listeners. They are good if you're playing the rewards game, whatever else it is. But at the end of the day, we still want to get it paid off. So when you're looking at cards, which we'll give you a resource here in just a second that you can go look at those. Oftentimes we are looking at the benefits. So when Robinhood goes and says, hey, $3,000 in benefits, it is kind of important, Scott, that we go look at what those are. A little bit misleading.
A little bit.
So they're offering a $250 DoorDash credit, which at first glance you're like, dude, I'm going to go get me a nice bottle of wine on DoorDash. But it's actually, you get $10 off per order with a $50 minimum.
Okay, I will jump in here though.
But that didn't even cover the DoorDash.
$50 minimum can be hit pretty easily. And now that there is, Drizzly got acquired by them, you actually can order alcohol. And if you order DoorDash very often, there's this, I forget what they call it, what the term is, but you order your food, and then of course it's enticing you of all the other places along the way that you can add to your order. So $50 is
goes fast.
Yes, it can go quickly.
Well, in order to get the $250 benefit, you have to order 25 times in a year and save $10 a piece. In the Satterfield household, we probably wouldn't get that one because DoorDash in our house is called our 17-year-old son, Ethan.
In the Clynch household, we might get that in a month and a half. Okay.
Okay.
No judgment, please.
You're
Any listeners, no judgment.
All right. We're going to throw that one out. That's not even a real benefit. Okay. Next one. Function Health membership. I don't even know what that is because we live in Texas. You get a $365 credit. The problem is that it only works if you live in New York, where the membership costs $615. Everywhere else, it wouldn't even help. And there's not even one in Hawaii or Rhode Island. So that's a bit of a problem. So I think that one's getting thrown out too. The Aura ring, which, do you have an Aura ring?
No,
I don't even.
I have a traditional steel, whatever.
Yeah, I have the
little
little silicone rubber one when I go hiking or whatever.
Yeah.
But I don't have the Aura ring. You get a perk, a credit of $70, but you don't actually get to buy. They don't give you a ring, so you got to buy the ring. Anyway,
Lame.
Yeah, there's a hotel credit of $100, but it's only at certain hotels, and you have to go through the Robinhood portal, which means you're not getting the discounted rates. And then last but not least, they have a $250 credit for autonomous rides that, unless you live where there's Waymo or Robotaxi, wouldn't help anyway. I think my
big
point
player
here
for Scottsdale residents right there.
That's
big
right.
player.
Yeah. LA and Scottsdale. I think the takeaway here, Scott, is that this 3,000 is not really 3,000.
No,
not even close.
It's not even close. Nope.
So if you're really looking for credit card perks, which is good broadly, if that's the way you want to play the game, we continue to send people, like NerdWallet's a great spot. NerdWallet, go in there. You can look at cashback cards versus hotel points cards versus I want access to different lounges, or I want airline miles, or whatever else it is. You can kind of key those in, and they'll give you the range of different cards that might make sense for you. But sort of just going to like a headline and saying, oh, this Robinhood card is certainly going to be the place because I'm going to save 3,000. If you look at the fine print, not so much.
What's your go-to? What do you get on your credit card?
Well, I fly a lot for work, so it's miles.
Same.
Yeah.
American Airlines.
I mean, the reality is that we do travel. You may be a little bit less right now with the kiddos, but for my kids being older, I travel quite a bit for the office, and so it just makes a lot of sense.
So the window, I think it's the same for everybody, but the window of when your miles expires the end of February, I missed it by $1,600.
Oh,
$1,600 for the year.
Not enough DoorDash ordering.
Not enough.
Yeah, clearly. All right. Last but not least, folks, we always want to polish it off with a good S&P 500 talk. There was a great article from Wealth of Common Sense, which is one of my favorite personal finance books, really ever, that's out there. And he went and said, what are the worst peak to trough drawdowns every year in the 2020s? Meaning, during 2020, what was the worst drawdown from the top of the market down? Doesn't mean the market finished there, but what was it during intra-year? So 2020 is a great place to start. It was a 34% drawdown, which we could pretty much say that was from probably mid-February through the end of March.
Correct.
That was an easy one. Then, of course, the market actually finished up that year, but that was the biggest for the year. 2021 was 5%, was the biggest one. 22 was 25%. And then the last 3 years have been 10, 8.5, and 19. So there's a lot to take here from this, Scott. But first, to me, what this screams at is that every year is going to have a significant amount of volatility. I mean, the lowest one on here was 21, where the market seemingly just crept higher every single day. And yet we still had a peak to trough down of 5%. So as we're in the midst of this one right now, which is somewhere right around 6%, I mean, y'all, this could be way, way worse.
Absolutely, it could be a lot worse. I mean, with all the instability that's going on globally right now, you would think that the market would have fallen a lot sharper than it actually has right now. And the funnier thing about this is if you go back and look 2020 through 2025, the closest correlation to the biggest peak to trough drawdown during a year to where the actual year ended is 2022. So the biggest peak to trough was a reduction of 25.4%. The markets at large were down around 20%. So that's the closest one. And it's all tied to inflation and interest rates. So opposite of what we talked about earlier, while interest rates have risen, small business has also risen. People have not been afraid to go out and get loans, yet the market itself has not reacted well to that compared to all the instability around the country.
Yeah, and I think the other thing that's really helped here is the market's broadening. Like we talked about on this podcast a lot this year. And so when the market broadens, even though there are pockets that are drawing much more significantly, the rest of the market's kind of helping bolster it a little bit, or hold it up a little bit. So I mean, I think that the takeaways here, folks, are, again, other than, you have 20 where the market peak to trough was 34% and 22 where it was 25%. Last year was about 19. So there's some nasty years. Now, what's interesting about 20 and 25 is those drawdowns happened early in the year. So the market had time to claw itself back. The 22 one was a sort of structural Fed increasing rates all year. So it couldn't draw itself back that year. If, we see this continual sort of negative, market performance here early in the year, if things settle down a little bit, we get a more clarity on inflation and interest rates and the geopolitical scene, we probably claw our way higher, by end of year. Yeah. If something happens latter part of the year, it could still be, kind of a nastier year from that perspective. That being said, during that whole time over the last 7 years, the market's just absolutely phenomenally higher. And so again, that's the big takeaway, I think, when we look at something like this. There are also, sort of miscellaneous risks out there. Margin debt is at an all-time high, and so obviously that could create problems if the market has a significant peak to trough drawdown as well. So lots still at play there, but it's good to remind ourselves that, hey, these intra-year drawdowns always happen. So the one that we're in right now is not unique in any way.
Right.
All right. Well, fun as always. Scott will be back with us next week as well. Thanks, man.
Yeah. You're enjoying it.
You're a decent sub in for Judson, except you're also the Texas Tech. So it just drives me nuts when it's like, hey, let's pick March Madness. Red Raiders. All right. As always, folks, the best way to keep up with us is to subscribe to this podcast. That way you will never miss when Scott joins us or any other episode. And you can go back and listen to all the others. If you're enjoying us so far, leave us a review. Have a question, comment, or a crazy social media video for our next Fin Talk, drop us a line at canewaters.com/wealth. We really do answer these. And if you want to learn more about what we do when we are not in here or out of the office like Judson, visit canewaters.com to see how we are helping over 3,500 clients reach their long-term financial goals. Hook 'em.
Wreck 'em.